This is the turning point that everybody's been waiting for. And now I'm going to tell you why potentially $6 trillion worth of cash is about to move into the markets and inflation is going to get wild. You came here for the truth, so let me unveil that for you. You've got to look at some fundamental aspects here that can't be avoided. And if you understand the reasons why those occurred, it's going to explain what will happen in the next 12 months, all here in this video. The first thing you got to understand is that money markets have been the safe haven for investors, both on the retail side and the institutional side over the last while. There's been big concern. Oh no, I don't know what's going to happen. It's 2020. Everything's been shut down. Let's just park some cash in these money markets. And what that is short-term, highly liquid cash. But it was giving right now, recently, 5% return. So, hey, it's liquid. I could pull it out anytime I want, and I'm going to get a 5% yield. That seems about right. So people were choosing that over the stock market, and that continued to grow and grow and grow, getting to the point where $6 trillion worth had been parked in this, what was kind of boring, kind of ignored for the most part. Of course, every portfolio would include some of this because you would have access to it. If you want to deploy it somewhere, you would always have it. You don't necessarily want to keep it in the bank. You want to keep it right there, actively waiting for you so that you could hit two buttons and now move it into bonds. Now you can move it into stocks. Now you can move it into this or that instantly. $6 trillion worth is far greater than anything we've seen before. Now the understanding is we just had a Powell pivot, a Fed pivot, where the Federal Reserve has basically said, look, it's not going to get any tighter. It's going to get looser, and you might as well come on in. So that tells you what we are about to see in 2024, and investors, as BlackRock has said, have been given the green light. So what's going to happen? Are they going to keep all $6 trillion in those money market funds? Or is that going to start draining? Well, I'm about to tell you that it's already begun. You got to watch me through this video because I'm going to explain it all. Every angle of it, okay? Retail investors have been piling into money funds last year when the Fed began one of the most aggressive tightening cycles in decades. But this week, the Fed signaled that the campaign is over by projecting deeper interest rate cuts in 2024. Oh, that's right. This is a pivotal moment for cash. This is a turning point, and you do start to see money move out of the money market funds into riskier assets, into term rates to lock in higher rates. As cash rates start to come down, you're penalized in 2024 for holding cash because the rates of the prospects going lower, okay? That is actually what has begun. Money funds assets are their first outflows since October. Does the trend continue? I think that as long as the Federal Reserve says, you know what, yeah, next year probably going to be easier, and they just kind of hint in that direction. They don't necessarily say, uh-oh, inflation's going wild, we need to turn it the other direction. Then this would probably continue. That means, just as BlackRock said, it's a green light. Knowing that, what occurs with asset inflation, price inflation. I'm not talking about CPI. I'm not talking about core PCE. I'm talking about asset prices. This could make them go wild. Now, when I look at it statistically, it is certainly overbought right now at the time of this recording. There's no question about that. The CTAs, which are the computer programs, as of this recording, this week coming up, they are actually programmed to sell. But when we look at it over the grand scheme of things, the market has every reason to want to go risk on right now. Risk on, let's do it, let's party. It's 1999 because inflation is going down. And hey, everything is a-okay. That doesn't tell us what will happen, a year from now. We don't know. But as I'm looking at it right now, statistically, that's what's been happening. And if you look back on my track record, you could see how accurate it has been so far. Like I said, at the time of this recording. So you've got to see what has been going on historically. S&P 500 performance around the start of the Fed cutting cycles. We don't know yet, of course. We don't know when the Fed's going to cut, but this is the case. So a little bit confusing, but what you're looking at right there in the middle, that line, it's the months around the Fed rate cut. And, it depends. Are we recession? Are we not recession? Is it soft landing? Did Powell, fix it all? Wonderful. Anyway, if they are cutting because of recession, then, we get some turmoil. There's no question about that. However, when you look at it, the median of all episodes during this period of time, we would experience after, a couple months, just, a few short months of turbulence, that the markets would be higher afterwards. Okay. And the markets, let's be honest, looking at individual stocks, looking at the Magnificent Seven, but also looking at, the broad markets in general being pulled up by those few stocks, we're at or near all-time highs, right? Seasonality this is, by the way, we covered this in the Finance Friday, my live class that we do. And this right here is talking about seasonality, and it's a follow-up to what we talked about on Friday to those in the group, but you could see it in the chart. And that is basically just highlighting the fact that every year, 1950 to 2022, generally during this time of year, the market moves upward. The bias, overwhelmingly though, in all cases, is that the market moves up. There are periods of time in which the market goes the opposite direction, and it often gets violent during those periods. But the bias is buying, not selling. Okay, we need to understand that. So fighting against that in general is not a good idea. You got to be really smart with your timing. This just shows us what's been going on, a big concern in my opinion, which is the fact that the banking crisis is clearly not over. There's a lot of problems that have been undiscovered, despite the fact that we've had a lot. I mean, SVB, we have Credit Suisse and all that. The usage of what they call the Bank Term Funding Program. This is like the emergency program that was set up after SVB collapsed, Silicon Valley Bank, in 2023. Like, it's $124 billion worth that they are borrowed from this mechanism, which, by the way, in a few months from now, will be gone. In a short period of time, it will be gone unless they extend it. So something odd is going on in there, and we have to understand that that is going to have an impact on what happens broadly inside the financial system. As of this time, hey, everything's okay, right? What happens? I don't know, but we could have a locking up. Like, imagine suddenly what happened back in March 2023, even to a more extreme level back in 2008 to 2009. Suddenly credit just really tightens up, and that affects the economy overall because it's all run on debt. So keep that in mind. I will highlight any important details in the coming videos. Hit that thumbs up button if you want to be able to make sure you get that. All the future videos will be as detailed as these here, getting into the nitty gritty so that you understand it in depth. This shows us the regional banks have been going up considerably. So despite that, despite the fact that they obviously have a problem, the market is doing very well in this respect. We are not back to the levels we had in earlier, prior to SVB collapsing, but it doesn't seem to affect these stocks. So the understanding here, overwhelmingly, money market funds, everybody parking their cash in. Now there's potential that they would be sending that out of the money market thinking, hey, everything's going to be fine. We're going to have rate cuts. Everything's going to be just fine because inflation's going down. And now is the time to put more of that cash. Is it going to be a tsunami? Well, only time will tell. And I want to know your thoughts on this as well. You've got to look at the assets. I will track that here on the channel so we can make sure week by week to look at where it's been going. You could also look at the attractiveness of the bond market because that will absorb some of that as well. If the yields start to drop, if suddenly you're not getting as much on those bonds, then you could see more money wanting to go into the stock market. So keep an eye on that as well. So those are the few things that you should be watching to keep an understanding of, where the market direction is heading. At the same time, you want to look at indications like the RSI, Relative Strength Index. On a short term scale, you'll be able to see, is it overbought? And at the time of this recording, it certainly is. Or is it oversold? Okay, that's in the opposite direction. All these things I will cover in tomorrow's video as well. So you definitely want to stay tuned for that. Hit the thumbs up button to be more likely to get that video in your feed. Share this with your friends and family. This right here, what I'm showing you is the Finance Fridays. We also have a Sunday, which is a business/e-commerce live. What I do, if you want all the details about those two programs, it's depth that you just can't find it anywhere else. Okay, I don't BS, I don't beat around the bush. I give you all of the depth that I have. That's 2 hours on Friday. That's 2 hours on Sunday. Depends on what you're interested in. If you're interested in like e-commerce, selling products, selling digital products, that's Sunday stuff. Finance Fridays is 2 hours of in-depth. We look at charts, we look at the economy, I go through a presentation, like all these things. Fantastic resource for a lot of people to just extract as much data as they can from me, because I'm spending hours and hours and hours a day, and then I can consolidate that and bring that to you. So if you want to apply for that, please do. It's a link in the description. Comment of the day: companies that suck should fail. And he's actually quoting, I want to thank you for that, he's quoting me. And I totally agree with that. Look, we've got to have an economic detox. If something isn't good, why are we keeping it around? The best things should rise to the top. When we bail out these companies that aren't very good, you're creating a moral hazard for them to spend money, for them to screw up. Take your money along with it, because you probably got to be the one to bail it out. I don't agree with it, but that's the way it goes, right? You let me know what you think. And as always, I hope to see you tomorrow. Make sure you go to the search and type in the Money GPS, because it might not come up in your feed. I'll see you then. Take care.